Alrighty, so let's get to other taxes, payments, refundable credits. So there's going to be a lot of material in this next coming segment. It's definitely going to get more involved, and it's very alluring and it's very attractive. It's going to be fun. You're going to enjoy it. But there's one thing to note. So it's going to be like everything else. It's going to be a lot of material, but the system automatically calculates these things for you guys. So from the information that we input, the system will do these things for you. It's just knowing and recognizing what these things are when a taxpayer asks questions. Oop. So, other taxes. So, the way we're showing and representing these credits to you guys is the form in which they show up on the 1040 itself. So, what was the first thing that you guys remember today? What was the first topic? Deductions, that's right. And then we had adjustments, and then after that, non-refundable credits. So now we are in other taxes. Does that make sense to y'all? Does that make sense? We took the adjustment, we did the deduction, then we had the adjustment, then we calculated the liability to find the non-refundable, and then we have our other tax. We have our other taxes. It comes later, which is weird, right? So other taxes are in addition to those shown in the tables and the figures from the compilation. So these are your self-employment taxes. So these are our contract workers. So this tax happens after your non-refundable credits. So this tax shows up after your non-refundable credits. So your non-refundable credits can't help those taxes. So this is your self-employment tax, your Social Security tax, your Medicare taxes for on tip income. And this is additional taxes on your IRAs and qualified retirement plans. This is if you take them out early. And then you have your repayments on your first-time homebuyer's credit. I don't think you guys have to worry about the repayments because the last ones are this year?
Last year.
The last ones were last year, so you guys won't see these because they have already been repaid. That was back in 2008, way back when.
They had 15 years. Well, I think it was back in 2008, 15 years. So you will see it on the 2020.
Okay, so this will be the last year for the first-time homebuyer's credit. These people will know that they have to finish this off. They're more than excited to. There's ways in which we can check and make sure. But if they come up to your site, then the site manager will probably handle that more than likely.
And if they don't tell you about it, that's a reject.
It'll reject, so it won't even go through if they don't include it. But these people have been doing this for 15 years at this point. They should know that they need to include it on their tax return to finalize that. These amounts are usually calculated on their own from the forms and the schedules and are entered into the 1040 Schedule 2. And these taxes, again, are after the non-refundable tax, or not after the non-refundable credits. The non-refundable credits do not reduce the other taxes, okay? So these will happen after the non-refundable credit. So everything we talked about earlier would play no factor into these taxes. So the self-employment tax, this is a big one. This is where the liabilities come into play. The self-employment tax is the Social Security and the Medicare taxes collected primarily from individuals who work for themselves. It is similar to the Social Security and the Medicare taxes from the pay of most wage earners, except a self-employed individual pays both in the employer part and what would be the employer part. So most W-2 workers, you saw on the W-2, they had the wages, they had the Social Security, they had the Medicare. Remember those lines 1, 3, and 5? So now, these individuals who are your plumbers, your contract workers, they see this tax at the end of the year for the full amount. So your next tax is your IRA or your qualified retirement plans. If a distribution is taken before a taxpayer reaches 59.5, it is not rolled over into a qualified plan or an IRA, and no exceptions apply. Taxpayers are subject to a 10% penalty of the distribution. So if you take out your retirement early, you will see and you don't have any exemptions that apply, you will face an additional 10% penalty. So these are all the common exemptions on the 1099-R. You guys remember we saw that yesterday? Here are some of the other distribution codes as well. You don't have to memorize these. Just know that they do exist, and each number illustrates a different type of situation. So how do we put that in the form? So how do we put this in the system? If the system will automatically calculate this, but this is if there's some exemptions that do apply, we can fill out this additional form called the 5329, and we can make the determination based on what the information that we have. You guys more than likely would not handle that at a standard site location. Most site managers, assistant site managers will handle this portion of it because that takes a little bit more information and a higher knowledge that we don't require of you guys. But for informational purposes, this is what it looks like, the Form 5329. This is if they have a tax on that penalty amount, but they do have some exemptions that apply. We would apply this form to mitigate the 10% tax. And other taxes, your HSA. So your distributions not used for qualified medical expenses are subject to a 20% tax. So we talked about the HSAs earlier and the amounts for the contributions. Does anybody remember what contributions qualified for the HSA or what you could use your HSA for? Medications, over-the-counter medicines? Appointment, doctor's visits, yeah. Prescription medications and feminine products, good job. So if you use it for anything other than that, you have a 20% tax, okay? And your first-time home buyer's credit, like we spoke about, the 15-year plan, this is the last year for that. So these guys, or these individuals, they pay $500 per year from their tax return to help pay back the amount that was borrowed. So this will be the last year for that. There's a certain section that we put this information in. It's not that many individuals. I think it's maybe one or two per site. And they know what they're supposed to do when they come in. They'll let you know. And so the excess advance premium tax credit. So the marketplace, the 1095-A, it works in two ways. It can be seen as a credit or it can be seen as a tax. So with the 1095-A, is that's your marketplace insurance account. How it works is when they set up these accounts, or how they're supposed to set up these accounts, is they project the amount of benefits you receive based on the amount of income that you have, or the amount of income that you would make throughout the year. So if a person says, I'm going to make $50,000 this year, I think I'm going to make about $50,000 this year, they'll say, okay, well then we'll adjust your benefits to match the amount of income that you have. Let's say the person says, I'm going to make $10,000 this year. And then they get a job and they make $60,000 that year. They'll still be getting those benefits at their projection of $10,000. So how does this pertain to taxes? If they're getting more than their benefits are supposed to be allowed, they have to repay that amount that was given to them as benefit. So it definitely confuses taxes. It's a bane of our existence. It makes taxes not complicated, but it increases the amount of rejections because a lot of individuals get into those situations we talked about yesterday, or was that here? Where they get signed up for these programs, they don't know they exist, and then they're getting all these added benefits, and then they're seeing a tax that can't be, that they have to face. Yep. And so this is the 1095A. This is what it looks like. This is the 1095A. It'll have the information here. If they have any dependents, it'll go down here, so it'll have the covered individuals as well. What we're seeing here is just who's all on the return. We have to make sure that it's everybody that's on the return is on the 1095A. It'll get confusing very quickly, but this is what it looks like. This is just the basic information. We don't have to input any of this information. The TaxSlayer software will ask you if all the individuals in the household were covered on this, and if it's yes, it's yes. If it's no, it's no. And that's what it looks like. We don't got to put in policy dates, terminations, or anything like that. But what we will have to do is this section, and you better hope that all these numbers align. The issue is if they have different coverages throughout the year, if they adjusted their plan throughout the year, we will have to put the different numbers for each cell throughout the entire year across all 3 rows. So if they match for each row, we can put the subtotal that's on the bottom. But if they don't match between months, we have to input for every single column. So you see why it's a pain. This is the most word form, so you'll see it very commonly. This is your Obamacare, it's your marketplace. And that is what it looks like. In the real world, it'll be filled with numbers, and you'll have to put them in. If there's blanks for some numbers, then you'll have to put them in, and things of that nature.
And you will see this again on one of your test questions.
And you will see this in real life. This will definitely be a form that you see very soon.
One point we might want to point out right here is on the 1095A, anyone listed on the 1095A must be listed on the tax return. And if it's not, it's out of scope, and we cannot, because it has to be allocated.
Yeah, we have to do some more math that we don't have the time to do, and nor does your certification allow. So what she was saying online is that if they must be included on the tax return if they're included on the coverage, because we have to do some allocations. All right, so payments. The federal income tax system is a pay-as-you-go system. That means that tax is paid as income and is earned or received during the year and is referred to as the withholdings credits. W-2s, 1099s, W-2Gs. Typically, we'll do this as on a pay-as-you-go method. Many taxpayers have income from self-employment, dividends, interest, capital gains, rent, royalties, and the pay-as-you-go system also applies to this income. If the tax due on this income exceeds certain limits, estimated tax must be paid quarterly by the taxpayer. If an estimated tax payments are not paid, they are required a penalty could be imposed. So this is why we kind of, for some of our contract workers, we say if you know that you're going to be doing X amount, it might be in your benefit to go ahead and do an estimated tax payment throughout the year, so at the end of the year, when you come to do your taxes, you're not facing a large liability or a penalty tax. Taxpayers who overpay their income taxes in 1 year can apply all 3 parts of their overpayments in the next year estimated tax by indicating the amount they want to apply. Taxpayers can get an automatic 6 months extension to the time of their file by submitting a 4868 application. We will do these both electronically and via mail. We usually start giving these out starting the last week of the season. We'll start handing them out saying you got to mail this in by a certain time, or we can actually electronically file these. And typically, if we hold these extensions when there's more complications involved, or it's not going to be able to be resolved within the coming days before the tax date, which is what date? Does anybody know the tax date for this year? April 15th, that's correct. So they can get an extension, and that's why we're open all year round, is because we do taxes in the summer and in the fall, and then we handle our extensions as well. And so this is what the payment section looks like. I believe one of the certification tests has an estimated tax payment that you will input, and it can be found in the payments section under this column, page H9 in your Pub 4012. All right, so we talked about non-refundable credits. We talked about other taxes. And now let's get where the big money lies. Let's get to where a lot of these paid tax preparers promise people. And this is a refundable credits portion. And the first of which is the additional child tax credit. So does anybody remember what the other one was called? What other child credits were there? Child tax credit? And it was a non-refundable? Is that correct? All right, so now we have the refundable portion, which is the child tax credit. The child tax credit is generally a non-refundable credit at first. However, certain taxpayers may be entitled to the refundable additional child tax credit. Taxpayers with more than $2,500 of taxable earned income may be eligible for additional child tax credit if they have at least one qualifying child. Taxpayers with 3 or more children may be eligible for additional child tax credit regardless of their income, and is limited to $1,600 per child. Y'all see where the money starts to come in? You see dollar signs in your head? And then here's the next one. This is the earned income credit. Earned income credit. It is a refundable tax credit for most people who work but do not earn high income. So this is another incentive the government has for individuals who go to work and make money. They say, okay, because you went to work, here's a refundable credit for, going out there and bootstraps. The purpose of the EIC is to reduce the tax burden and to supplement the wages of working families and whose earnings are less than the maximums for their filing statuses. Eligible taxpayers can receive a refund with this credit even if they have no filing requirement, owe no taxes, and had no income tax withheld. All taxpayers and dependents must have valid Social Security numbers by the due date of the return to claim this tax credit. I believe there's a... So this is what is needed in order to be able to claim the EIC or the Earned Income Credit. You have to have taxable wages, salaries, or tips. You can have taxable long-term disability benefits. You can also have self-employment. And here are the things that don't count. I've had some taxpayers who had children who were receiving child support attempting to try to claim EIC. They don't qualify, I'm sorry. And the system will automatically calculate the EIC amount for you guys. So this is the worksheet that kind of shows what all is involved when it comes to the EIC and how an individual can claim the EIC. It's a good one to look up, especially because I believe the certification test asks about the EIC qualifications. It's going to be on page I-4 on your Pub 4012. It's good to look at it and see. I would say pay attention to Part D here on this side because it breaks down what filing status is that you need to have, what's the income limits for each, if you're single versus you're married, to be able to actually receive the EIC, because there's a lot of misnomers in the tax industry that says because you're this person or you have this thing, you're entitled to this EIC. They say, oh, you need to be, when you go do your taxes, you should be getting the EIC. But there's a lot more at stake when it comes to actually receiving it. There's a lot more that you have to be able to actually qualify for the EIC. And it's not something that you just automatically assume. So I have a question. Do you think that you can be single and receive EIC? Who says yes? Or hand? Okay. Who says no? Okay. The answer is yes. So individuals who receive these types of credits, the disbursements for these credits don't happen automatically. So the tax season starts for us in 2 weeks on the 22nd. The actual e-file date is the 29th. But disbursements for these refundable credits, because these involve more information and more forms, and these are your higher level $10,000 and $20,000 returns, they hold those and they wait and they process those at a later date. So anyone that has any of these credits on their tax return, it's held until mid-February. And they'll start distributions for these types of tax returns at a later date. And just as you can receive EIC and CTC and ACTC, you can be disallowed for these credits as well. So a lot of paid tax preparers will say, oh yeah, you can get this credit. I can fudge some numbers and get you this credit. The IRS will say, oh, hold on, you don't have no kids, or we don't have those forms. How did you get that? And what they'll do is they'll either permanently disallow, they can permanently or up to 10 years disallow you for certain credits if you illegitimately took them. And this is what that looks like. If they've been disallowed, most taxpayers would know of it. Some aren't aware, but it will reject for disallowance. So if they're trying to claim an EIC or a CTC, a child tax credit, or additional child tax credit, and they've been disallowed, it'll kick back in our system and say, hey, this person has been disallowed. You need to go back to the taxpayer and let them know. And so this is the 1095A again. Under the Affordable Care Act, the ACA, the federal government, state governments, insurers, employers, individuals share responsibility for the improving quality of availability of health insurance. So this was to give, so like we spoke about earlier with the 1095A, it can be seen as a benefit or as a tax. So when you underproject your income or you overproject your income, and let's say you overprojected your income, and instead of 60,000 and you paid those benefits on just on the 60,000 value, but you actually made 40,000, it's seen as a benefit. But if you underestimate your income, it's seen as a tax. So the ACA works in two ways. It can be seen as a benefit or a refund for your tax return, or it can be seen as a tax on your tax return. And so we'll still write up that form and we'll see what happens. And that's why we have to put in the cells for the values, and whatever the outcome is what it is. So you can receive the premium tax credit or you can receive the tax. All right, a taxpayer has interest income of $4,500. His earned income is only $7,000. He is single, has a valid Social Security number, is not the qualifying child of anyone. Does he qualify for EIC? Let's go back to that chart on I. In your Pub 4012. And that should have been I-4 in your Pub 4012. Who says yes? Okay, okay, coming up slowly. Let's just say he's under the age of 25.
No. I think yes.
Who said yes? And why is that?
Well, his interest income is below 11,000, so that's fine. His income is under 17,640 with no qualifying children.
Yeah, so he is within the range to receive EIC based on his income. So the answer is yes. It's below the threshold limit for a single person with no children. And can you tell everybody where you saw that in the table?
It's in step one, the last line.
Step 1 on the last line, she carried it across. Yes, sir.
Provided this early, did you say that the taxpayer was under 25?
No,
Because I asked, what was the age of the taxpayer?
Oh yes, it should have been under the age of 25, yes. All right. Okay, another question?
So even if you're under the age of 25, if your earned income is below the threshold, it doesn't matter your age?
Oh, you gotta be over the age of 18 and under the age of 25. I'm sorry?
65 now?
Yeah, as a single person. Under the age of 65, but over the age of 18.
Yeah, that's why it's confusing, because on the chart it says at least age 25, but under age 65. You gotta be 25 if you don't have a qualifying child on the table.
Okay, yes, I'm sorry. Yes. Over the age of 25 and under the age of 65 without a qualifying child.
Okay, so because you said the taxpayer.
I'm sorry, I misspoke. Yeah. It should have been over the age of 25.
So if they were under 25, their income still wouldn't matter?
Yeah, they wouldn't have qualified. That's correct. So the original question was no, but what I wanted you to find is yes. My apologies. Jewel and her daughter lived with Jewel's brother, Emmett, all year. Jewel earns $20,000 and claims her daughter as the qualifying child for EIC. Emmett is 25 years old and earned $8,500. Is Emmett able to claim the EIC for a taxpayer without a qualifying child? Emmett is 25 years old, has earned $8,500. Is Emmett able to claim the EIC for a taxpayer without a qualifying child? Yes or no?
Yes.
Yes.
The answer is yes.